Stay hungry, stay foolish.
The Innovation Show exists to bring you content that you may not hear elsewhere, so you can make better decisions, whether that be in your personal life or in your organization. And it's thanks to our sponsor, Xi, boldly transforming the future of financial services with a suite of embedded products and services, empowering businesses to manage multiple payment workflows and move funds with ease. You can check out Xi at helloxi.com. Let's get into Bank 4.0 with Brett King. Before we get into Bank 4.0, it's useful to put some historical context on the other phases of Bank. Bank 1.0 started in the 12th century with the Medici family, and it was essentially about guarding your funds. Let's zoom in to Bank 2.0, which was banking beyond the branch. This was with the advent of the ATM, and in 1995 with the advent of the internet. Bank 3.0 zooms in once again, and it emerged in 2007 with P2P payments, mobile banking, and challenger banks. Bank 4.0 is embedded ubiquitous banking, AI layers over the banking, contextual banking, where it reacts to your spending and gives you an advice in real time. It is a great pleasure to bring you the author of Bank 4.0, Banking Everywhere, Never in a Bank. He is the founder of Movin. He is the host of Breaking Banks Radio, and he is our guest on today's Innovation Show. We welcome Brett King.
Thanks for having me on, Aidan.
It's great to have you on the show, man. I already know this is going to be an absolute cracker for so many of our audience who work in change, not only in banks, but in change itself. And I thought that's where we'd start, a bit the challenge of that before we get into the spine of the book and the narrative of this book. Let's talk about that, because you have the scar tissue. This is not somebody who's just a founder who's just gone off. You've gone out because you've experienced the very friction you were trying to fix within a legacy organization. Maybe we'll start there, Brett.
Before I started writing the books, I was doing digital transformation for the best part of a decade within banking. Particularly around the internet. I worked with HSBC, Standard Chartered, Citibank, Amex on global digital strategy, back in the noughties. It was tough. Obviously, you have within the bank, you had these innovators, you had these change agents who were trying to get this stuff done. But back in those days, there was still the overriding mantra inside that branches were the primary way banks would always do business. And so breaking that cycle, even just getting application forms for products on websites back in those days was extraordinarily hard, because there was like, well, why do we need to put on the web? Because they can just come into a branch, and do it. But there was a lot of history. So I was frustrated, and I thought, everybody that's in my situation as a technologist must feel the same. They need someone to champion this. So my idea behind writing my first book, Bank 2.0, which became that series, was essentially that a change agent, a innovation lead, a digital head would be able to take that book to the CEO or the head of retail and say, don't believe what I say about the change, read what this guy says about the change. And that's exactly sort of how it worked, and why the book became a bestseller and was so successful. I heard that story so many times, where the head of digital would go to the CEO would read the book and go mind blown and buy a copy for all the senior management team, and that was how the sort of groundswell of support for the first book took off. And that really changed my career personally.
It's magnificent, and I'm really so happy that you've been through that. You've broken out. You've proven that you can go and fix the friction that you were experiencing as well. But there was one last thing I wanted to say there. You mentioned, for example, when you give talks and keynotes, for example, this was towards the end of the book, you said this, was many former CEOs or CEOs who are just about to retire would come to you and go, man, that was, whoa, whew, thank God I'm retiring. You're like, oh, that's the problem.
Exactly. Yeah. Because they don't want, it's like it's too hard to deal with. But, you have to understand that banking as an industry, where it's unique from other industries, is at least in some other spaces, you will get individuals saying, this represents a competitive opportunity for us. This disruptive, what's happening in the industry is as a competitive opportunity. That is much rarer in banking because of the risk adverse nature of banking. Any change, the organization's been trained that any change is a potential risk to the business. So that's what you've got to deal with. So the way, I've progressively done that over the last decade or so is to talk about the fact that the greatest risk is for you to do nothing, and getting people on board with that. And particularly now that's easier because of the massive success that fintech has seen from an investment perspective, from, the challenger banks who are now some of the largest banks in the world, at least in their respective markets, like, Nubank in LATAM, who's the largest bank by market cap there, N26, the second largest bank in the German market, and so forth. Those sort of things illustrate the fact that, well, you've already lost market share. So what's your next plan?
One of the things, we'll come back to regulation because it is a huge blocker for so many people who are actually great change agents who want to drive change, but as you say, they're hamstrung by regulation. And in some cases, they face imprisonment if they make mistakes. Like, it's not as if they're making these on purpose, maybe like 08, the financial meltdown. If they make mistakes, they face imprisonment. So it actually, fear petrifies people from making changes at all. And we'll come back to that in a second. But I wanted to start where you do in the book, because one of the main cores of the book, the main principle throughout, is getting back to the concept of first principles, which is so important for any innovation, particularly when you're trying to transform a legacy industry or organization. As you tell us, this industry goes back to the Medici family. So perhaps we'll start there with the concept of first principles that's so important to understand if you're going to transform any legacy industry, but particularly a bank.
First principles is generally thought of as a physics concept, but, it has its place in engineering. If you look at some of the most disruptive innovations or inventions throughout history, they really did redefine the industry, and reset it in terms of expectations. So if you think about the problem of getting information, from the east to west coast of the United States, it used to be the Pony Express, and then the telegraph line came along and completely disrupted that business. The automobile, and how it changed our view of personal transportation. What's happened with SpaceX most recently over the last 20 years in terms of how they've redefined the space industry using reusability, and the creation of the iPhone. These are all examples of innovations that really reset industry expectations and the business models around, a technological leap. So we see this in elements of banking today, particularly the basic bank account is shifting to a cloud-based value store, an intelligent cloud-based value store. So today you see mobile wallets today do twice the number of daily transactions globally when compared with plastic cards. And so this is something most bankers don't even know about, right? They think that issuing a debit card is going to be something they're going to be doing for the next 50 years. But if you look on a global basis, from a financial inclusion perspective and from a day-to-day payments perspective, mobile wallets overtook plastic in 2017. And so, that is a massive change, in terms of the way we think about a bank account. Because a bank account was always an artifact that was issued from the bank branch. It used to be a passbook, then it was a checkbook, and then it was the plastic card. And mobile wallets are different in that respect, in that they're embedded in a technology infrastructure, as part of an operating system or whatever. And that shift just that basic nature of the bank account is a major one. But that, the way we think about access to credit, like we've been trained that that's a credit card that you use for primary day-to-day access to credit. Now we're seeing contextualization of credit. So buy now, pay later, Apple Pay Later and other stuff that, Affirm and Klarna and so forth. But this is just the start of that shift away from products that were designed for distribution in the branch, moving to sort of this technology-based utility. So banking is really getting deconstructed and redefined based on first principles. And you have to sort of get through to the audience the fact that we have seen this pattern before. And when this happens to an industry, all of the previous leaders in the industry are decimated because they normally can't change fast enough. And that seems to have, as an idea, has resonated with the industry at large that, sort of got behind the book. Yeah.
You quip a little bit in the book that there's loads and loads of first principles thinking in the industry, just unfortunately not in the banks themselves. And it's the fintechs, it's the startups, it's the Movens, it's the Zai, who's the sponsor of this show. It's those type of companies who are starting from first principles thinking and taking over so many. And you tell us about this is actually one of the reasons that places like emerging industries like Africa and even in China are so far ahead of the West because they didn't have to transform legacy mindsets, legacy technology, the rails, as you say. They're starting from scratch, just like you did in Moven as well.
Well, that's it. I mean, for Moven, when we started Moven in August 2010 was when we registered the domain, and then the company was formed, early the following year. But, back in those days, even just being able to apply for a bank account in the app, which was, we were the first app that allowed you to sign up for a debit card. We didn't actually want plastic. We wanted to go straight to a digital version of your bank account embedded in the phone. But, MasterCard and Visa wouldn't let us. No, you have to issue a card. We don't have the POS support for, contactless, ubiquitously yet, as an example. But, we were really focused on financial wellness, helping people save money with their bank account, which you'd think would be a basic element of banking, but it's not. In fact, if you look at the way banks make money today on credit cards, as an example, with the reward programs and cashback and airline miles and things like that, it's you're pushed to spend. Right, which is in the current environment is disastrous for someone's financial health. You want restraint. You want help people with the psychology of savings, the behavior of savings. They're elements where we need significant development on that. So, but just lowering the friction, just enabling you to get a bank account without a wet signature. Back in those days, 2011, 2012, I mean, as you say, from a regulatory perspective, that was very, very tough. We had to convince regulators that this was as safe as someone walking in a branch and signing a piece of paper. And we had to demonstrate that. So there were some real hurdles to those early, types of innovation in the space. But thankfully now, the momentum, particularly behind the startups and the fintechs, as you say, has created this competitive landscape where traditional players, incumbents, are having to adapt because the fintechs have been so successful with that innovation.
Yeah, and I just want to let everybody know, Brett wrote Bank 4.0. I don't have a copy behind me. I have a copy of Breaking Banks because I have it on my iPad, but he has a copy right there as well. And he wrote that pre-pandemic. But get a load of this. I pulled a little excerpt here to show you. It's just so far ahead some companies are towards Bank 4.0. And here's a little excerpt. Within 10 years, based on current growth and financial, perhaps, Brett, you'll tell us a bit about this, will be valued at more than $500 billion. And by 2030, it will likely be approaching $1 trillion in market cap value. This would make it 4 times bigger than the largest bank in the world today, ICBC of China. Today and financially, it is roughly worth the same as UBS and Goldman Sachs, two of the most well respected banking players in the world, Ant Financial has a first mover advantage as a true first principles financial institution built upon the utility of mobile. I thought I'd use that little excerpt for you to explain about this company, about Ant Financial, but also about how they are so close to what you envisage for banking of the future, which is Bank 4.0.
So Ant, they've changed their name to Ant Group now, but Ant is the largest fintech in the world. They're based out of China. They're the parent company for Alipay, which is the largest mobile wallet operator in China. In fact, globally, they've invested in mobile wallet schemes all around the world to become an aggregator of mobile payments. In 2020, China did $52 trillion of mobile payments. Now, why that's notable is the rest of the world did $35 trillion of plastic card payments. So that's sort of putting it in scale in terms of what they're doing. But they also have the most successful savings product of all time called Yuibao, which is a savings feature they built into the Alipay wallet. And prior to the pandemic, they got to the point of almost $300 billion of assets under management in that savings pool. So much so that the central bank deemed it necessary to put restrictions on deposit sizes for that feature of Alipay because it was so disruptive in the market. But here's the point: is prior to the recent restrictions we've seen around Jack Ma and the tech companies and so forth in China, Ant was on track to IPO at around $330 billion, which would put them in the top 2 or 3 financial institutions globally. That was in 2019. Now, obviously, the political landscape in China has changed somewhat, but not the fundamentals around Ant in terms of their growth. If you look at why Ant is successful, primarily it's because they have fully embraced being a technology-first player in the banking, and payments space, and so that is their competitive advantage. When you look at their org chart, you look at their board, it's made up of technologists. When you look at their executive team, they're all, got deep technology experience. When you look at many of the modern banks, world leading banks today, historically, they might have 1 technologist on the board, maybe 2 at a stretch. And then innovation or technology is a department, that's the digital team, right? Or that's the innovation team. And the entire business it's like Apple or Facebook or Microsoft. Their entire team is focused on technology that can really advance the needs of their customers and users. So that's the challenge you face as an incumbent in this space, that it's not just about access to technology, but it's the cultural issues within the organization about using technology to do banking day to day that you've often got to fight against because the culture of the organization is trying to reinforce the old model.
Yeah, and we'll come back a little bit if we have time to the org chart, because Brett does this brilliantly in the book, gives you an org chart of the future, the roles you need, the people at the table, the mindset of the CEO. Everything is covered in this book, and it's a culmination of all the books before, but they also are so valuable to read as well. But let's move to regulation. As I mentioned earlier on, I work with many banks, and regulation always comes up as the blocker, and this sometimes can be the case, but also you tell us we can try different things. But let me give a little quote again that's magnificent here that will bring it to life for so many people. You say, if there's one area that is going to need a total first principles rethink, it is regulation. Presently, we're in the vernacular of the software industry, madly adding patches to the system, trying to retrofit decades-old regulation and core systems for all these new channels, behaviors, and technologies that are emerging. But the more we try to add fixes to the system, the more we get a sort of conflated banking spaghetti code, a system that threatens to lose its coherence at any time with legacy system and platform limitations that are already decades out of date. let's share your thoughts on regulation, because this is a huge challenge. And again, it's this whole thing about it's nearly easier to start from scratch and build from first principles. But one of the big blockers, even for the early movers, you've experienced this yourself with Movin and many of the other fintechs, is regulation. So let's share your thoughts on this.
The biggest changes here are around just structurally the way we think of a bank account, the way people behave. Regulation, that was built during the 70s and 80s in particular, supposes that someone's going to come into a branch and sign a piece of paper, and that's how you will deal with the disclosure requirements and so forth. The structure of products, like how you offer interest to a customer and so forth, often hard coded into regulation. So when you try and create some innovation around that sort of thing, you're going to have the regulator say, but that's not how we do banking. And so that's where the challenges fit. Also, think about this. The regulation that was built during the 20th century was not designed to scale up to millions of customers simultaneously doing types of activity. It was always having to be dealt with on a piece of paper. And it's same for things like anti-money laundering rules that we have, where you have these supervisors whose job is to go around and actually go through these suspicious transaction reports, like on a printout of these, thousands of transactions, identifying the ones that they're going to refer to the Financial Crime Authority as an example. Very antiquated approach. And that's why we're woefully unsuccessful at stopping money laundering today, is because those systems are designed for a time when data access was, printing out a spreadsheet effectively on a piece of paper. So, to be effective at regulating the future financial services industry, we are going to have to apply technology to be able to do the supervision at scale based on the massive amount of transactional volume that it's emerging because of the digital layer. And that requires a technology skill set within the regulatory bodies that currently, they're having to build from scratch, because it's not something that they've had as a core competency. And in many cases, as you automate the regulatory environment, you completely change the structure of regulation. So, if you look at the United States, there's over 70 regulatory bodies that manage the regulation function in the United States. The federal authorities, the state level authorities, even at the federal level, you have a payments authority, you have the OCC, you have the Fed, the FDIC, and often they're in conflict, So automating regulation would require a structural change to the regulatory bodies. That's something that in a country like the United States, they're just not ready for. The UK, as an example, is making some fairly good progress on that. The FCA has been, a leader in terms of running tech sprints and things like that. MAS in Singapore has been, fairly progressive, but those markets, it's somewhat simpler to deal with than, say, in markets like China, India, or the US, where you have, such a big regulatory infrastructure. So that, they're going to have to become technologists as well, and that's a big leap. That may, in fact, be harder than getting banks to become technology focused.
Yeah, and it's so important for them as well, because they don't, as you say, they don't understand. And for anybody listening who think this might be not relevant to you, think about AI or any type of replacement tech. So where you have to replace a legacy system with a new one, you're going to get this type of resistance anywhere there as well. So I wanted to just go a little bit deeper. There's another little excerpt I pulled here, because I love how you write about this. It's not just technical, it's from that scar tissue that we talked about that you have from working in the industry as well. So brilliantly written. You say, ironically, the very traits that have made regulators effective have suddenly become top contributors to new risks as a gulf widens between the velocity of market and regulatory change. Regulators must rapidly address new technologies that they don't understand and which are rapidly exposing current regulatory molds. Regulators are left at walking a knife edge between neither blocking emerging benefits nor allowing new risks to proliferate. The chance of all this going smoothly with minimal failures is honestly, as you say, zero.
And I think that characteristic of the adaptation of the overall regulatory space is sort of key. But as I say, it's a skill set issue. But here's where the fintechs have been able to move the needle to some extent. When you look at a bank's ecosystem, the immune system, when you try and do something new, often the compliance and legal team will say, well, no, the regulators haven't explicitly given us permission to do that, so we shouldn't do that. Right. Whereas a fintech will say, well, the regulators haven't specifically denied us the permission to do that, so let's do it. And if we get in trouble, we'll adapt then. Or actually going to the regulators and saying, we did this as Movin. We'd like to try this. What are the conditions with which you would be happy for us to prototype this in the market and, see where this goes? So that's the fintech culture in terms of experimentation and trying new things versus the incumbents. What we generally found as a startup is going to the regulators and having those conversations. They were like, yeah, we've talked about this internally. We'd love to see a trial on this. But none of the big banks are coming to us asking us about this because the big banks were saying, yeah, but it's the regulators haven't said yes or no on this first. So that's the chicken or egg problem that you see in the incumbent space, whereas the fintechs tend to be more experimental and consultative with the regulators, and that's done them some favors. Now, that doesn't mean that all fintechs have an easy time of it. We've seen Revolut and others sort of get the slap on the wrist and be pulled back sometimes, and I think that's fair. Especially where a risk is emerging, a unique risk is emerging based on their business model. But having said that, it needs to be a consultative progress. You need to be proactively innovating, and that needs to be a process of going to the regulator saying, this is what our intent is. How do we do this safely? And that will give regulators a lot more comfort and support for your innovation initiatives.
Rather than seeing them as an enemy, they embrace them like the fintechs do, like you've done with Movin, for example. But one of the other things that you mentioned that there was money laundering. And as you say, unwittingly and definitely against their will, banks have become almost like they have to take this upon themselves. So they're not getting much help as well. And that's distracting them. We've said, for example, a CEO of a bank will get your book and go, we got to do this. But everybody's like, but we're so busy trying to keep the lights on with the existing business. How can we possibly do this? We have to invest in ourselves. We have money laundering. We have blockchain. We have crypto. All these different things are going on in the background. And you're asking us to do this on top of everything else. That's a huge thing that happens in most industries that are transforming. What are your thoughts on that? Particularly that you mentioned, for example, how ineffective we are at money laundering, but particularly the onus has all gone onto the bank, and it seems somewhat unfair.
If you look over the last 20 years, 60-70% of incumbent IT costs have been regulatory and compliance based, whereas fintechs, when they're building from scratch and they're building up to date regulation and compliance stuff into the stack, but they have an easier. They're more adaptable to that because they have newer tech and they don't have legacy systems and legacy code and so forth. So that's a distinct advantage you have. Where in a fintech, essentially 95% of investment is going into the innovation, whereas with the banks you're limited because you've got to change all that legacy stuff. So that's a challenge, which is why when we see banks trying to experiment, really with sort of digital direct models and so forth, putting a new organization outside the old org chart, being able to put new technology in place, new leadership and experimenting and trying something new is often an approach that is quite successful. But then you've got the problem of, when that startup that you've created on the side, has been successful, what are the lessons you can take back to the larger organization? And you still have the challenges with the legacy, org structure to fix. But I think if we look out a few years in respect to this is where artificial intelligence really changes the game. Because as we deploy more robotic process automation, and as we have artificial intelligence embedded in our lives, it's going to require radical transformation there as well. We're going to be replacing a lot of, human process-led workers in the banks. We're going to be, changing the way the banks can respond in real time to your needs for the utility from the bank and so forth. So as that AI competency builds up, then you have no choice but to sort of rethink the way the function of the bank works, even from a regulatory perspective and in respect to sort of core capabilities. And that's why I say in the book that regulators have to become technology companies too, because if you take something like AML, the easiest way to tackle AML will be to create large pools of data on transactional data, have AIs mine that data to find suspicious actors and cut their access to the system, like we would with hackers, from a cybersecurity perspective. And that's going to improve our success at stopping money laundering significantly over the current system. But, we're talking about a grassroots change in the way, regulation is executed in respect to money laundering.
One of the other things you talk about there, and it's falling under the remit of regulation because of the money laundering that inevitably takes place within this realm. And unfortunately, there's a lot of bad actors which give a bad name to the good actors, which is digital currencies, cryptocurrencies, ICOs, etc. I'd love you to share your thoughts on that, because that's also a big challenge for regulation.
In the book, the way I describe it is that, we are digitizing the world. And as part of that, fiat currency as it stands is not really well suited to a real-time borderless environment. Neither are many of the ways we think about products. The big thing, in over the next 10, 15 years in particular, is that as we try and automate supply chain and as we try and improve the flow of money in an automated society, we're going to have to create these smart contracts. Those smart contracts won't use fiat currency. They'll use CBDCs or stable coins or tokens. So that is the way we're going to automate commerce at a global level based on artificial intelligence. And that changes the way we think about money, particularly because it becomes programmable and embedded in these AI-based systems. So that's the shift that's occurring at a macro level. Then, you've got at a geopolitical level, the issues of, US policy and how USD is being used, and China wanting to reduce reliance on petrodollars and sort of de-dollarize the world. You've got the commodities markets, which about half of commodities trade globally today are energy-based. You've got renewables and energy reform coming in that's going to dramatically change that. So there's a lot of macro stuff that's happening there, but crypto and digitization of the tokenization of the world is largely inevitable as automation comes into society, because the way we think about money today and the way bank accounts work today, they won't adapt to this highly automated world that we're moving to.
One of the other challenges, just to get through from a regulatory perspective, and you've experienced this with moving, is the cloud. So the misperception that the cloud is not safe. And in some cases, you said, for example, in the book, comically, that some regulators were like kind of going, we need to know who have key cards for your server. And they're like, well, the server's in the cloud. You've experienced this yourself with moving and the challenges with regulation.
Often regulators will want to know where is the physical hard drive located that stores this information, as an example. And that's a very traditional way of looking at things. What we do know today is that when you compare a bank on-premise system compared with the likes of Azure or AWS, as examples, Google Cloud, that these cloud environments are they're hosting all of these next generation apps and technologies, and the first thing that's going to happen is fraudsters are going to jump in and try and hack the system or whatever. Amazon, .com, for example, running on AWS, constantly attempts at hacking and taking users' credentials and all of those sorts of things. So it's like an immune response that those cloud-based systems over time by necessity have had to become a lot more secure very rapidly. Whereas the sort of flavor of attacks, cyber crime and cyber attacks that you might see on a traditional on-premise system may be limited just because of scope. So as a result, we now know that cloud-based servers or cloud-based operations are much more secure than on-premise solutions. But helping regulators understand that, it has taken years, frankly, and now finally, when we've seen operators, like fintechs, operating on cloud-based servers for a decade without those instances of risk that everyone thought would exist in the cloud in the early days, it sort of has solved that problem. But you've still got on-premise champions in banks. And there's a lot of incentive for bank executives to build their own data centers and so forth because they get more budget, they get more people and so forth, rather than outsourcing part of their architecture to cloud operators.
Yeah, and again, you talk about this in the book. We won't have time to cover it today, but even your own experience with moving versus moving in HSBC, where you were in the incumbent industry, moving was so slow, and it's so frustrating for the change maker as well. But let's not move on from regulation, because I don't want our audience to think that this is picking on banks. Yes, there are some people who are clinging to the past, but there are lots and lots of people trying to make the change, and it's bloody difficult for so many of them. And Brett, within all his books, gives solutions. And in the book, and particularly on the section on regulation, you suggest some elements of reform for regulation, and you tell us success will require strategies grounded in first principles of assuring financial system stability, customer fairness, and curtailing money laundering. You share some critical elements here of regulatory reform. Perhaps you'll bring us through them, some of them even at a high level.
I was very fortunate for the second chapter of Bank 4, which deals with the regulatory space. I was very fortunate to work with Joanne Barefoot. Joanne has worked globally on policy and regulation. She's advised the FCA in the UK. She's advised MAS in Singapore, APRA in Australia, and of course, she was the deputy comptroller of the currency at the OCC in the United States. So, I had a delightful time working with Joanne on this, because she really understood the regulatory environment and the need for change. But at its core is about the fact that if we look at the function of the regulators in the past, that supervisory function will still exist for these regulators, but it will largely be based in code rather than individual examiners going around looking at the compliance of the banks. So in the future, the bank's compliance AI will talk to the regulators AI, and that's how the compliance will be verified or checked between the bank and the regulator. Again, big conceptual shift, but it needs to be clear that when we look at things like terrorist financing, suspicious transaction reporting, and all of those things that have become such a big part, even KYC, know your customer mechanisms and identity verification, those things have become so much more reliant on technology. So even if a supervisor, an examiner goes to a bank to check on compliance, very soon the examiner will be just looking at a black box functioning code and won't really be able to assess, the compliance capabilities of the bank unless they're just looking at outputs, from that black box. So it does require a real reset in terms of thinking and capabilities at the sort of grassroots regulation level. The biggest challenge with that is not necessarily around the ability to adapt within the regulatory body, because there's plenty of people who are now sort of fighting that fight, but the fact that the mode of regulation is sort of hard coded in laws that are going to have to change. So if you take the US around financial inclusion, there was a law put in place in 1977 called the Community Reinvestment Act. And this defined in 1977 that the best way to financially include people was to have them have access to a bank branch so they could ask for credit. Today, we know that a mobile phone is a far better vehicle for financial inclusion than a bank branch. But that law hasn't changed in the United States since 1977, 50 years ago. And so therefore, you have these traditional banks who are subject to that regulation saying, but we need to keep these branches open because the law says we must. And you've got these digital guys like, Chime and Varo and Current and Movin and Simple that are coming along, and they don't need branches. So it's an unlevel playing field. So you should stop them from being able to open bank accounts digitally because we can't do that in the same way. So, that's part of the challenge you've got with these hard-coded laws that are in place. So the way to fix that, of course, is as we move to AI-based regulation, you are going to have to encode the laws on the books that make the most sense, and that's going to require acts of parliament, legal reviews, and things like that create that reform. So as we automate more and more of the banking system, we're going to have to go through that process of review.
There was a line that I wanted to quote from your book that will account for all change. And this goes to your point about you need to have sandboxes and test beds, small incremental changes that you can make with regulation even, for example. And you said that regulated entities should be given a choice here. They can remain in the traditional regulatory process they hate but know, or they can elect a new data-driven RegTech channel, submit to intensive real-time scrutiny, and be relieved of process-oriented compliance requirements. The government stance here would be that if the entity can prove through data that it is meeting desired outcomes measured using transparent and empirical standards, then regulators need not care how they got there. And here's the line that I thought was a brilliant line that will make sense to all the change makers who listen to this show. Making this new channel optional would avoid the biggest obstacle to regulatory reform, namely the need to force change on the entire system at once. That's one of the biggest challenges, is that we try to boil the ocean instead of making little changes to different parts of the bank here in this instance, instead of one big change.
Demonstrate it, just show the ability of this technology to transform the space, particularly when you look at something like AML, right? We know that data science and data modeling are going to be much more effective. In fact, the regulators I speak to, like FinCEN in the US, the Financial Crime Unit and so forth, they know that this is the way it's going to eventually go. The only question is when. Should it happen now? And now my view on that is, look, if it's going to happen anyway, then let's just get on with it. It's that's the lesson you learn out of innovation historically. Is there's no real benefit in slowing it down. No industry has successfully been able to stop technology innovation. So let's just get on with it. But being able to show that sort of A/B approach, like this is the new way we're doing it, this is the old way, which is more successful from a data perspective? What are the outcomes that we're achieving? I think that is the easiest way to sell the lawmakers and the policymakers on the success of automating the regulatory function.
I think you're so right. I think that's one of the big challenges is because they can't imagine what you can see clearly in your head. They can't see it. So you show them a minimal success rather than selling them an idea in the first place. It's much, much easier. But I wanted to also jump into Bank 4.0, the reimagined Bank 4.0, and also try and get org chart in there before we finish, because Brett, as you can see from the introduction, has limited time. He's a busy man and he's been on calls all day, and it's only AM over in New York where he is today. So you say here that in the 19th and 20th centuries, the value of a bank account was primarily that it kept your money safe, that you could save money securely and you could pay for stuff based on the authority of the bank. When you wrote a check, people would trust it as a mechanism of value exchange because a bank was behind it. The value in a 21st century bank will be in how it provides utility in context, how it adapts to your financial life and your behavior. The bank account is transitioning to a smart money artifact, bank utility embedded in our world, enhanced by artificial intelligence that responds to your financial needs as and when they present themselves. So let's share some of the principles behind a 21st century embedded smart bank account and how it will change the way all of us live with our money.
So there's the org chart graph that you're talking about.
If it's okay with you, I'll share that on the screen so people can see it.
The key element here is that we're moving from, we're moving to a real-time world. And in that real-time world, I'm solving your financial problems as they appear. So the illustration I give in the book is walking into a grocery store and you fill up your cart and you get to the checkout and you give the cashier your debit card and it's declined. Right now, that's a scenario where a traditional banker would say, "Oh, you need a credit card." But a technologist, a first principles innovator would say, well, no, you don't need any plastic, obviously, right? But what do I know that can help me solve this problem for you? Well, I know how much you spend on groceries. Every 2 or 3 weeks. I know you've just walked into a grocery store or a supermarket, and I know your bank balance or your wallet balance, and I know you don't have enough cash to complete your grocery shopping. So as you walk in the store, I can present you with a solution now. So this is sort of the contextualization or embedded banking. And now we're talking about the next layer of technologies like smart glasses that are going to come over the next few years. Imagine walking into a Tesla dealership and seeing which Tesla you can afford, right? With the financing offer, or walking into a listed real estate property and seeing a home financing offer on your smart glasses. So that's a sort of embedded utility of banking that we're talking about, plus a money coach in your pocket, helping you save money. You could ask your smart bank account, "Hey, Aidan, you could say, can I afford to go out for dinner over the weekend with my mates?" And your bank account will know how much you can spend over the weekend without compromising your goals you've got for the end of the year or upcoming bills that you might have. Your smart bank account saying to you, "Hey, you've got to pay your car insurance in 3 months, but on your current cash flow, you're not going to be able to afford that. Here are some strategies for you to mitigate that." This is what a smart bank account is like. It's embedded in your life, giving you access to banking when and where you need it. And that's a very big shift from the old days of, you go to the bank and you jump through these hoops, and if you're not too risky, if you're very lucky, we might give you a product. That's sort of the bank perception of risk. So it's a completely different risk model. It's real time. It's when and where you need it. This is really the big shift behind smart bank accounts embedded in a wallet versus sort of the dumb bank accounts like a check or a credit card or cash that don't really give you any contextual feedback and don't adapt to changing conditions.
I'm going to annoy our audience if I don't get to org chart before you run out of time today, Brett. So I'm going to jump into that. So this is, what does the org chart of the future look like? And I'm going to show, with Brett's permission, the org chart that he gives in the book. And I highly recommend the book. There's checklists in there. You also follow Brett's podcast, and we'll ask where to find all those in a second. But here you say, when the automobile was invented, the dominant form of urban transport was horses. Within 30 years, that had all changed. Along with it, the shape of cities, manufacturing, and support systems around cars. When the telephone was invented, it rapidly changed communication. The same is patently true with the impact of the iPhone. Not only has it changed the way people think about their phone, but it created entirely new ways of doing business via apps. It changed the music, and the taxi industry markedly. It changed the hours we spend on our devices, and it changed the way people consumed and created content. So it begs the question, Brett says, how do we organize the new competencies in the 21st century Bank 4.0 bank? Do you simply create new roles in existing businesses, or does it require reorganizing the business to be more effective from the ground up? Over to you, Brett.
The biggest shift is really moving from a posture of a product-based organization to banking experiences and utility. So the example I gave of the grocery store, that really destroys, as does buy now, pay later, those types of scenarios. It destroys the credit card business as a product, because getting rewards or cash back and so forth is not the motivator of this future world. It's the contextuality, the ability to solve a problem in real time. And that requires access to credit. It doesn't require a credit card product. And the same exists for mortgages and savings and investments and so forth. So you think about an org chart in a bank today, those are all departments. The wealth management team, the mortgage team, the credit card teams, and so forth. Those teams shrink dramatically because they now become experts at understanding, embedding the banking function in a customer's life. And then you have to create the experience around that. So it's experience design, it's behavioral psychology, it's data science that supports that. So that's really the big shift is building great experiences for customers, building the delivery capability in terms of the tech stack. That's how, fintechs don't talk about core systems, for example. They talk about their tech stack. That's where the agility of the organization exists technically. So they're the big changes, moving from a product to an experience-led org chart and, building the technical capability to deliver that in real time. And then the data science or the behavioral stuff that was really going to ferret out those unique opportunities for your brand versus another one where you can do something different based on data or behavior or emerging trends in the customer space. And it works for retail as much as it does for commercial banking. Just even the ability to help someone manage cash flow at a business level and anticipate when they need credit, instead of asking them for 3 years of financial data, like their statements and stuff. Now, we've got all that data. We can actually produce an accounting ledger from your bank statement. We can do that in real time with AI. And so now we can tell you as a business when you need credit based on your business activity rather than the other way around, as sort of an example. It does blow things up from an org chart perspective, though, for sure.
Brad, have you time for one more question?
Of course.
Okay, let's do this. So I wore a pin, especially. I have a practice of wearing a pin for each show. This one says adapt or die, by the way, and it's a picture of a moth.
That's one of my chapter headings.
Yeah, exactly. So I was delighted when I saw the chapter. I was like, I have a pin for that. So I thought we'd share your thoughts on adaptation, because there's a chapter called Adapt or Die, and it covers all types of disruption itself. And here you say, disruption is not new. When you look back over the last couple of centuries, you see time and time again evidence that incumbents underestimated the impact of change on their industry. In the banking sector today, the huge potential changes we're facing are no longer just focused on front-to-end user experiences. We're seeing currency, capital markets, wealth management, bank licenses, labor force, and economics all under attacks from emerging new systems, paradigms, and technologies. The biggest question, you say, probably is, why is it when faced with disruption, incumbents don't react any faster? It's like a mixture of disbelief in the speed of change combined with fear over being disrupted, which often creates a condition like a deer in the headlights of an oncoming vehicle. You know you need to move, but you still get hit anyway. And here you share some of the indicators, some of the triggers that disruption, and those headlights and that car is coming straight for the deer that is many, many banks throughout the world?
Core to this is really the culture of the organization in terms of being able to adapt. And that starts at the board level. It starts at the CEO level. I always get asked, the most frequent question I get asked when I'm speaking to bank boards or at a banking conference is they say, tell us a bank who's really good at this. My first answer to that will be, look at Ant, right? Ant Group, because they're better at this than anyone else, but they're not a traditional bank. No, not the fintechs. Tell us a bank that's really good at this, as if if we can get a bank case study that demonstrates this, maybe we can get permission to do this. And when you look at, and there's only a handful of them, globally, where that you got really progressive banks, but it all starts with the CEO. Jamie Dimon, with Chase in the US, BBVA historically, Piyush Gupta, the CEO of DBS Bank in Singapore. There are a handful of bankers who have made this shift, who are really driving their organization to this new reality and have been very successful at it. But they're far and few between. That's really the challenge of that industry disruption that we talked about. Is so much inertia, which is generally why I say the largest banks and financial institutions in the world in the 2030s will be fintechs. Just like we've seen in other industries that have been disrupted, these technology-first players most likely will be the new, foundational elements of banking in the economy. And historically speaking, this is fairly common. When you see these industries being disrupted by these major technical developments, the core industry resists. Look at the movie industry and the music industry. They spent hundreds of millions of dollars trying to stop people downloading music and films. If that effort had been put into reforming the industry and putting these innovations in place, it would have been an entirely different process. It was inevitable in the end, but there was so much effort spent at defending the existing business model. And that's the biggest guarantee of failure as a brand in this new world of banking that we have is the resistance to that inertia.
Brilliant, Brett. And for people who want to find out more about the Breaking Banks podcast and find out more about Moving and indeed yourself and all your books, where can they find that?
Go to brettking.com. That's my personal brand page. Of course, breakingbanks.com. You can check that out. We just launched a new podcast called The Futurists, sort of a little bit more sci-fi, talking about changes happening at a macro level. So check that out. And you can connect with me on LinkedIn, Twitter, Facebook, Brett King Author on Facebook, on Twitter at Brett King, and LinkedIn. You should be able to find me easily.
If you had one last message for our audience today, one last call to action to legacy banks in particular, what would that be? Start today. Move. You're not going to make progress in this by debating whether it's the right or wrong thing or not. Become a technology first champion. That's going to be the way to guarantee the success of your career individually and the success of your organization. Founder of Movin', host of the Breaking Banks podcast, author of multiple titles, but today the focus was Bank 4.0, banking everywhere, not in a bank. Brett King, thank you for joining us. You're welcome, Aidan. Thanks for giving me a chance to have a chat. Thank you for all you do for change makers, people who are struggling to make change in banks as well. That's been my platform, because I used to be I still am, I guess, but I used to be in the trenches at HSBC, and it was just so hard to get stuff done, And even in the face of real evidence that things were changing, the resistance, the immune system of the organization in terms of, trying to stop change and innovation was so strong. So that's why I wrote my first book, Bank 2.0, back in 2010, Well, thank you. I mean, it really speaks to the very core of this show, because this show is for those people. Loads of people who work in banks listen to the show as well, because it's mentally unhealthy for them Such a pleasure to bring you this increased content and this bespoke series powered by Zai. Zai is boldly transforming the future of financial services with a suite of embedded products and services, enabling businesses to manage multiple payment workflows and move funds with ease. You can check out Zai at hellozai.com, and I see you very soon for another episode.